In this video, traders, let's look at ideas for stop placement when day trading. Stay tuned. Hey guys, warm welcome to you. Thank you for joining me. All right, so one of the challenges we have as day traders is where the heck do we put our stops? Now listen, when we're trading a particular price pattern, then we normally go, okay, well, I'm going to put a stop above a key level, below a key level, and that makes perfect sense. You know, example here, I've got the DAX in front of me, 5-minute chart. If, say, for example, you were going short, you'd probably want to have a stop above that high, right? Not too close that it gets pinged out on a wick, but far enough away it doesn't get pinged, but also in the right sweet spot that really, if it's going to go, you want to be stopped out and not caught on some kind of a momentum drive. Fine, let's look at it in a different perspective now. I've got 3 ways for you that make it very easy to place a stop. Now, I think that there's a hybrid method of doing this. So the ones I'm going to kind of discuss with you in a moment now. Let me know what you think of these guys. If you've got any others as well, please do feel free to share them in the comment section below. This is definitely a kind of crowdsourcing thing here. We can help each other out and find you can help each other out and help other subscribers out and watchers and viewers, etc. You know, that's what it's all about, really. But you can kind of use a bit of a hybrid model and go, okay, well, I might use these fixed stops, the ideas that I'm going to show you in a moment, and then combine them with a key level as well. But let's have a look and see what I'm talking about. So, for example, let's say you're trading the DAX, very popular vehicle for day trading, especially if you're index traders out there. 5-minute chart, fine. How would you place a stop? So, apart from a price action based stop, what are your options? There's a few things to do. The first one is to go, right, what is the biggest candlestick on the chart that I'm trading? Now, if you're trading a 1-minute chart, you use 1, 15, 15. I'm using 5 for an example. How do we do that? So we put an indicator on, we put average true range on, and on average true range, we set that to 1, and that's just showing us the range for 1. And I always like to use a histogram here. And I've just got a funny thing that I like to have it yellow, and I like to have it a little bit thicker as well so I can see what's going on. Let's have it there. So what does that mean? Well, it means that we can look and go, okay, what was the highest candle? Well, the highest was a 50-point candle here. Yeah, this one here went up to 13,220 down to 13,170. So a 50-point candle. So you can say, right, that's going to be my stop. Now, for some of you that might be a bit wide, in which case you can go, okay, what was the biggest candle in the last hour? So you're trying to kind of align with conditions. You go, right, the last hour takes me to 226-ish. So the biggest candle was here, so 35-point stop. So literally you go, right, well, that's going to probably take me out the noise. Unless I'm very unlucky and I literally get an awful entry, especially if you've got things of the time frame we're trading as well, you're probably going to be coming out within a few candles time if you're trading a 5-minute chart. That's a good benchmark to use and go, right, here's a 35-point stop. Great, I'll carry on like that. So that's one way of doing it, and you're kind of then aligning with the volatility. You're then aligning with the current conditions. If it suddenly gets spicy, then you want to get involved. You're obviously going to be looking at the current biggest candle. So that's one way of doing it. Another way of doing it, again, using ACR. You guys know, if you've been around a while, by the way, appreciate all your support for those of you who've been around for a while, and welcome to you new viewers. Average true range. I love the average true range because it's just such a good metric and useful tool for so many reasons. I have not 10 period, and let's give it a little bit of a freshen up. Here we'll put it like this. So now what we're doing is we're saying, right, instead of the average true range showing us the range of one candle, it's showing us what it's supposed to, which is the average range. And it doesn't matter so much about the true part because I haven't got any gaps when we look at the intraday chart. And what we do now is we look and we see what's the average true range running at right now. Okay, and you can go, right, well, you know what? Let's put a simple last price label in. We can see exactly what we've got, and we go, okay, we're running at about 20 points. So the average true range for the past 10 periods or 50 minutes, because we're using a 5-minute chart, is 20 points. So we then go, fine, we're going to use a 20-point stop. And again, you know, this may not work for you, but it's something to use. You might say, well, actually, I want to kind of go a little bit wider. I want to go to 20 period, in which case you use a 20 period. You don't have to use 10. I just quite like the idea of 10 because it takes things into account that are very, very recent. Obviously, the smaller the number, the more sensitive it's going to be to current conditions. So, you know, that's one way of kind of doing it. And let me just put a label in, and I'm going to put the indicator last value. I did put the symbol last time, indicator last value. So that's a very easy way of doing it, 17.34. And if you go here and go back to 10, we'll see exactly what we had, which was about 20. Round it up to 20. So that's another way of doing it. ATR, great way of doing it. A final way to do it, not ATR, I'd be pleased to know, is to quantify the rotations. So bear with me, like, what are you talking about? So what we're trying to do here is we're trying to look for the high to low moves, and we're trying to quantify them or measure them, if you like, and then use that as a stop. So we go price range, and we go, right, when did we open? We opened here. So what was the range from here to here? So here to here, you can start to put it in. You go, oh, 90 pips. Well, that's quite a lot. That was the opening range. Does that really count? Probably not. Let's look at some of the more thinner rotations. Let me just change this a little bit, guys, because this is way too small. I've got to have it thicker so I can see what's going on better. Right. The other way of doing it is we do this. We go, okay, well, let's look at the rotations. The rotations really, we've had a 48-point rotation there. How many was that then from a kind of high to low here? We go, right, where's the high? Put it on the high, put it on the low. Oh, again, we're 48 points. All right, so what was it from kind of low here back to this high? 49 points. You get this idea, guys. We're about a 41 from this high to this point. The rotations are about 40 to 50 points. So use that as a stop. And it depends on what you're trying to achieve, doesn't it? If you're trying to scalp, you don't really want a 50-point stop. If you're trying to get a larger move, a breakout type move, if it breaks out, or a rotation back to lows, then maybe a 50-point stop is going to be okay for you. Again, double check your risk reward ratio, double check all those things. There's some tools you can use, and what the beauty of all these three is that you are aligning yourself with the current volatility. You're not forcing your stop on the market. You are looking and seeing and kind of aligning with the kind of conditions that the market's giving you. So what I mentioned at the beginning was you could use a hybrid. So one way of doing it is to go, right, well, I'm going to use a 40-point stop. Okay, or I'm going to go with my 20-point stop for my ATR. So what you can do is say, well, if I'm selling at the highs and believing this is going to constantly rotate, where's a 20-point stop going to take me? Well, a 20-point stop is going to take me to about here. Does that make sense? Yes, it does, because if it pings up to highs, I probably don't want it that level. Or you might go, well, actually, what about if I take a fake out? Well, you can start adjusting your bracket like this. TradingView very good for this. You can say, well, if it fakes out and I can hit it short at this level, means my stop's this level, means if it is a fake out and it rolls back over and I get a little wick fill to the short side, great, I'm looking really great, and my stop's going to be there, which will protect me from a breakout. So you can start to frame and get an idea on the trade. And obviously, if you've got a 60-point target, you're back to the lows here. That looks like a nice, feasible frame trade to take. So you can start to see as well and visualize where your stop's going to be. You can start to frame it in and do this and kind of bracket the trade and say, where would I really want to get a sweet spot if I wanted to take the trade to allow the stop to be at a sensible level. And another example, just finally, guys, if you're using that 20-point stop from the 10-period ATR, you'd put it here and you'd go, well, if I was shorting now, for example, my stop would be at the high. Does that make a sensible place for a stop? Probably not, because the market could easily have a little bit of noise, ping up and there. It's not breaking a key level, so it helps you stay, okay, well, you know what, I need a little bit more of an extreme price before I'm going to start hitting that short if I'm using my 10 ATR as a stop. Anyway, guys, there's three ways to use a stop. Let me know how you choose your stop when you're day trading. So many different methods out there. I'm interested to hear what you're got to say. By the way, guys, while you're down there, do check out our channel sponsor. Take care. See you next one. Bye-bye.